Welcome to Macro Money Talk, where we dissect the hidden mechanisms of wealth preservation and the architecture of financial invincibility. Have you ever wondered why the ultra-wealthy seem immune to economic crashes, while ordinary investors lose everything in a single downturn? It is not just about having more money. It is about building a system designed to survive any possible catastrophe. Today, we reveal the 5 pillars of this system, starting with the most fundamental concept known as structural isolation. This creates the foundation of a portfolio that can withstand localized failures without ever risking the collapse of the entire empire. Imagine a ship designed with watertight compartments. If the hull is breached in one spot, the water cannot flood the others. Structural isolation works exactly like that barrier. It ensures that assets are never pooled together in a single vulnerable basket. Wealth is subdivided across different legal entities and property boundaries, creating firewalls that legal liabilities cannot easily cross or penetrate. When one link fails, such as a warehouse facing a lawsuit, the damage is contained strictly within that single entity. It does not collapse the whole system, nor does it ever touch the personal assets of the ultimate beneficial owner. Most people hold all their assets in their own name, making them a single target for creditors and unforeseen disasters. The wealthy do the opposite. They own nothing directly, but control everything through a maze of isolated structures and legal shells. This separation is not just about lawsuits. It is about ensuring that a failure in one sector cannot infect another. If you keep all your eggs in one basket, you have to watch that basket with absolute, unwavering intensity forever. But if you isolate your structures, you can afford to lose a basket occasionally without it ruining your financial life. Think of it as compartmentalization for your money. It is the only way to ensure survival in a litigious world. By separating the ownership, you effectively remove the domino effect that destroys the middle class during major economic recessions. This is the essence of structural isolation. You build a moat around every single castle in your kingdom, without exception. However, structure alone is not enough. You must also defeat the greatest enemy of all investors, which is time pressure. This brings us to the second pillar, pressure immunity. Most financial disasters are actually caused by the ticking clock. When bills are due or debt matures, you are forced to come up with cash immediately, regardless of the market conditions. This forces people to sell their best assets at the worst possible time, locking in losses that could have been recovered. The wealthy build systems to completely eliminate this clock. They ensure they never have to sell anything to pay bills. They maintain massive liquidity buffers that allow them to ignore short-term cash flow problems that would bankrupt a normal business. Pressure immunity means you can simply wait. You can wait out a recession, a lawsuit, or a market crash indefinitely. They can wait through market dips without being forced to sell assets at low prices, preserving their long-term wealth trajectory. While others are sprinting to cover their monthly obligations, the wealthy are hiking slowly, immune to the need for speed. If you remove the pressure to sell, you remove the possibility of realizing a loss. You become mathematically impossible to bankrupt. This immunity allows them to buy when everyone else is selling in panic, picking up valuable assets for pennies. It is the ability to endure the storm that defines the winner, not the ability to predict when the storm comes. By constructing a life with low fixed costs and high liquidity, you create a shield against the arrows of misfortune. Pressure immunity turns the desperate need for survival into a strategic game of patience that you are destined to win. Once you are immune to pressure, you unlock the third superpower of the wealthy, which is time arbitrage. While the majority of the world is forced to think in terms of months or quarters, the rich think in decades. Time arbitrage is the luxury of ignoring short-term volatility because your horizon is far beyond the current economic cycle. Time helps smooth out mistakes. A bad year becomes irrelevant when averaged out over a 20-year investment thesis. They use time to compound their advantages, letting their assets grow undisturbed, while others interrupt their compounding with panic selling. Short-term risks become harmless in the long run. If you do not need the money now, the price today is irrelevant. This perspective allows them to invest in illiquid assets like real estate or private equity that offer higher returns. While day traders are destroyed by market noise, the long-term investor sleeps soundly, knowing time is on their side. Time arbitrage turns volatility into opportunity. It transforms the chaos of the moment into the certainty of the future. It is the ultimate edge. You are playing a game that ends in 30 years, while your opponents play for today. This long-term bridge allows them to cross over the valleys of recession without ever having to descend into them. But what happens when the problem is too big for even time to solve? That is when they use institutions. This is the fourth pillar, institutional risk absorption. When assets are large enough, the rules of the game change. Institutions like banks and governments prioritize stability over rigid rule enforcement when dealing with massive systemic players. If you owe the bank a small amount, it is your problem. If you owe a huge amount, it is their problem. Banks will work with large borrowers to restructure loans rather than force a bankruptcy that would hurt their own balance sheet. The wealthy use this to their advantage, leveraging the institution's fear of loss to absorb their own personal risks. They become too big to fail on a micro level. The system is incentivized to keep them alive and solvent. Instead of seizing assets, the bank becomes a partner, offering better terms, grace periods, and support to ensure recovery. This acts as an external safety net, paid for by the very institutions that are supposed to be the creditors. It transforms a potential financial death sentence into a manageable business negotiation, preserving the core of the wealth. Finally, to ensure the system is truly unbreakable, they employ the fifth pillar, diversification by failure mode. This is not just about owning many different stocks. It is about owning things that react differently to the same event. True diversification means holding assets that have opposite reactions to economic stresses, like inflation, deflation, or war. For example, when inflation spikes, cash loses value, but real estate and commodities often soar in price. By balancing these opposing forces, the wealthy ensure that no single event can ever wipe out the entire portfolio. They build an all-weather portfolio. If one engine fails, the backup engines kick in automatically to keep the vehicle moving. This is engineering, not gambling. It is about understanding the correlation between asset classes and their failure points. A monoculture is vulnerable to a single disease. A diverse ecosystem survives because different species handle threats differently. They hold different currencies, different jurisdictions, and different asset classes to hedge against every possible geopolitical outcome. Diversification by failure mode creates a defense in depth. The enemy may breach the first wall, but never the keep. These 5 pillars form a comprehensive system: structural isolation, pressure, immunity, time arbitrage, institutional support, and failure mode diversification. Together, they transform wealth from a fragile pile of money into an enduring legacy that can last for centuries. This is how dynasties are built, not by chasing the highest returns, but by eliminating the risk of ruin. You do not need billions to start applying these principles. You can begin building your own fortress today. Start by isolating your risks, building a cash buffer, and thinking in decades rather than days or weeks. Every great empire started with a single brick laid on a solid foundation. Your financial freedom begins the same way. The storm will come eventually. The only question is whether you will be the fragile house or the fortress. By mastering these 5 concepts, you take the key to your destiny out of the hands of luck. Wealth is not just a number on a screen. It is the freedom to live life on your own terms. Thank you for joining us on this journey into the mind of the strategic wealth builder. We hope it helps. If you found value in this analysis, please like the video and share it with those who need this knowledge. Thank you for watching this deep dive. Subscribe to Macro Money Talk for more insights into building your financial fortress.